Okay, everyone, welcome back. I get a lot of questions about NQ and how you can use footprint charts with NQ, right? So how this works is you have your regular ICT concepts, which is what we're going to be going over, but we also have the idea of order flow, right? So order flow is what you need to bridge together ICT and profitable trading. And the thing that holds you back is probably order flow. So let's quickly go over that, right? So here we have NQ. And just from an ICT perspective, you look at NQ, for example, I just want to start by saying the price action on Wednesday, the 8th, was pretty horrible. I mean, we had this range over here. I personally don't like this price action. I prefer to either sit out, take a break even, stay cash, or simply take and lock in 1-hour trades or 2-hour trades. That's kind of the way I like to do it, right? So again, here on NQ, right here on NQ, we need to just understand a few things about the market, right? So this was, of course, Wednesday. If we take some context for the week so far, we started the week off over here. We had Monday, Tuesday, and Wednesday. So when I use the power of three, I often like to use it on the weekly time frame first. So this is the weekly power of three, right? So as you can see over here, this is the weekly opening price. The high of the week is all the way up here, and Wednesday was down here, right? So we are below this weekly opening price. So what does that tell me, right? So when I look at price below the weekly opening, I want to be buying primarily below the weekly opening. That's kind of the way I like to operate. So I use the weekly power of three just to tell me where we are in line with the weekly opening. So we're below this weekly opening price. I look for buys. That is basically how the, I guess, algorithm works, right? So if we look more closely onto the price action we had on Wednesday, right? If we just go to the power of three, I just want to show people my settings. We can use the daily power of three as well. So the daily power of three is again more interesting relative to the day. And this is where ICT concepts becomes very, very powerful. Now we had the previous day, right? Previous day low. I love using the previous day low liquidity. It's one of my favorite liquidity types, right? Price from here takes out the previous day low, right? So when price takes out the previous day low, notice how over here in this region, we don't have a very strong close below the previous day low. So what you're seeing is you're seeing a data low or a very, very important liquidity sweep in the markets, right? When you see a previous day low being swept and price struggles to break below that, this is a strong indication that you want to be bullish for the day, right? This is where the ICT concepts with order flow becomes very powerful. So that's the first thing. So that's the second thing. Now, the third thing is we're looking at, of course, the power of three on the daily time frame, right? Now, again, it's the same concept as the weekly time frame. This region over here is below the daily opening, and we're going to be focusing on this region over here because we have a fair value gap over here, right? This is our inefficiency. This is our 15-minute fair value gap. So this is the 15-minute time frame. It is the most powerful time frame you can use for intraday trading. And just to give you some context, again, we use the daily power of three, and we are below this opening price over here. So really, we should be looking for longs, right? We're below the weekly opening price. We're below the daily opening price. And this is how I now form my key level. Right, so if we just take a look at price action over here, just again to give some context over here, what's happened is we've taken out the previous day low and we've swept it like this. Now price here struggled to break below this area. Price also left a 15-minute fair value gap, right? So this is now my key level. This is the key level I was looking at. So we've taken out the previous day low, and now from here, price has given us an inefficiency or a fair value gap just over here. So I typically tend to mark out the candle or the range just before the fair value gap over here. Again, you can have your kind of key level over here. Now, key levels in the market are very, very important. So what makes this key level high probability, and it's one that I wanted to use on the footprint charts, was again the idea we've gone through. It's taken out a previous day low. We're below the daily opening price. And also, to give some context, we also have an imbalance or an inefficiency up here. Price has also left an imbalance or an inefficiency from the London session. So this now becomes an overall target as well, just above the daily opening price. So with that being said, now let's go to the footprint charts and see how you could have got involved in the moves over here. Right, so if we just quickly go down to the 1-minute time frame, on the 1-minute time frame, again, we have a 15-minute fair value gap, and we also have this large 1-minute fair value gap over here. So when price comes into this level, we are simply looking to buy below the daily opening price in line with the order flow. And that's what we're going to be going over in this video. So if we just play price on, what we're looking for is a move into this zone, right? So now price comes into this zone, right? So in the New York session, right, this is now 9:30 a.m. to 11 a.m. Eastern time. We're looking for entries and setups within this region. Let's go down to the order flow footprint charts and see how you could have done this. So here on the footprint charts, we have the exact same price action as the NASDAQ, but here we're going to be diving into the candles and really understanding what price action is doing at this level. So this is the fair value gap over here, and we can see price rejecting here and rejecting here. So we're going to be going over the trades you could have taken in this region and, of course, in this region, targeting the highs from the previous New York session, right? So again, what we're looking at over here is we're looking at the order flow. So we're going to be diving into this and understanding what it means and why you need to be using it as a trader. So the first thing to note is, as you can see, when price comes into this level, we have some red delta over here. So just to give you some context, the candlestick charts don't give you the delta. So as you can see, when price comes in, I want you to understand this candle and really understand what's going on. This is the fair value gap in blue, and you can see a lot of red within this region, right? So what does the red represent as a trader, right? So as a trader, you want to be reading, you're at a bullish fair value gap with a lot of aggressive sellers. So you should have been watching some of my previous videos on the order flow series. The aggressive sellers are not being rewarded, right? You can see a lot of aggressive sellers over here. In fact, when we look at the order flow and really dissect it down, you had these numbers over here. You had 66 for 0. So there were no aggressive buyers in this zone. There were only aggressive sellers. So the aggressive sellers were driving price lower. But guess what happened, right? At this bullish fair value gap, we saw a rally higher. So what this shows us is that there's passive buyers that are sitting at this level that are absorbing the aggressive sellers, right? So one more time, when you see some aggressive sellers and the market fails to break below the fair value gap, which is down here, what this shows you is that there's more aggressive sellers than buyers, but they're not being rewarded. This shows you that the fair value gap to the upside is strong. It shows you that buyers are in control despite aggressive sellers, being aggressive in the markets, right? So they're aggressive, but they're not being rewarded. Now, the same thing happens over here. So we see price coming into this level, and this is the first trade you could have taken. I personally like to see the first tap being swept. So this first tap over here was swept over here. Now from here, we see the same thing, right? Look at what we see over here. We see a lot of aggressive selling within this region, In fact, when we go over here and look at the numbers, we read the order flow. What we read over here, some numbers that stick out to us. You don't need to read every single number. You need to read some of the key delta points at key levels. So you're not reading every single number. That would be impossible. But you're looking at some key delta that stick out to you. 56 for only 3. And then down here, we had 4 for 0. And we also had 102 for 10. This is a 10x. So there's 10 times as many sellers as there are buyers. But despite that, the market failed to break below the fair value gap. Now, once we see the price action over here, what we can start to say is, okay, the fair value gap is holding. It is time to get long. Even over here, as price breaks the fair value gap, price is beginning to break above the fair value gap. But when we read some of the numbers, we read, for example, we have 79 for 12. Again, there's a lot more market participants that are aggressively selling than there are aggressively buying. And what that tells us is that when there's more aggressive sellers than buyers, the level is being held by passive buyers. So we see passive buyers that are propping up. And this is what we mean by the absorption cycle. So the absorption cycle typically occurs over about a 10-minute period. So we're seeing a lot of aggressive sellers, and a lot of aggressive sellers. They are being absorbed by passive buyers. So when you see aggressive sellers that aren't being rewarded at a bullish fair value gap, this tells us that the fair value gap is strong and you want to be looking for sells, right? So for example, you could have taken your first long trade over here. This was probably going from about 295 up to about 369. So we had a nice kind of, you could have caught a 1 to 2 or 1 to 3 from here. And you could have also eventually caught the reaction up to here, right? So this all comes from reading key levels in the market, right? So again, if we quickly go over this candle as well, this candle rejected off this fair value gap, right? And the reason why any one of these trades would have been valid is because you're reading the order flow beyond the bodies and the wicks. The bodies and the wicks will not give you any proper information. But when you see all the aggressive selling down here, we see 4 for 0, 3 for 0. We see tons of red, which means that there's more aggressive sellers than buyers. The market failed to break below this level. The market failed to really break below these areas. So the zone is held. The zone is being rejected. Sellers are failing. Sellers are being rejected. And this is the reason why you could have caught this potential rally up. Now, I wasn't a fan of today's price action. It was pretty rangy when you look over to the side, right? It's quite a rangy day overall. But when you understand where to trade and you understand why to trade, you can then form an equation which can allow you to take great entries, 1-to-1s, 1-to-2s, 1-to-3s. When you're trading a range, having smaller or multiple trades is often the way to go, both for your risk, your account, and your psychology, right? So you could have caught a catch here. You could have definitely caught these two catches over here, right? You could have probably caught a 1 to 3, which is a fantastic day, a fantastic trade, right? So again, once you have a fair value gap, you want to be understanding where to trade, which is essentially a 15-minute fair value gap. And you can use the 5-minute or the 1-minute time frame for accurate entries. So once you understand where to trade using ICT concept, fair value gaps, below the daily opening, below the weekly opening, all the things we went through at the start of the video. If you can understand that with the order flows, you can read the delta, you can read the volume, right? So again, we've not really gone over volume today. But if we just go over back to the candles over here, to give people some context about volume, right? Volume will dry down when the market is uninterested in those prices. So for example, over here, you can see we have some zeros at the bottom, right? You can also see we have relatively low numbers over here, 6 and 8, 5 and 8. We see small numbers where if you go over here, we begin to see a lot larger numbers, 78 for 23. What you're seeing is you're seeing a decrease in the volume, right? You're seeing less market participants trading at this level, This again shows you the market is uninterested in these prices, and that then shows that there's likely to be an expansion either to the upside or the downside. Now, how do you find out whether it's to the upside or a downside? Again, you want to know where to trade, so you need your location. And you need to know why. So what is going on at that level? Aggressive sellers aren't being rewarded. That means that passive buyers are at this level. The fair value gap is strong and you should be looking for buys, right? This is a quick trade recap. Again, I trade ES, not NQ, but with lots of questions on NQ, I thought I'd make a video about it. So if you like this video, give it a like, give it a thumbs up. And if people are interested in one-on-one sessions with myself at Price Action Labs, I'm offering one-on-one sessions, so there'll be a link in the video, and there's a checklist to my for a free checklist to how I trade as well. So if you're interested in learning order flow and ICT combined, and you're interested in some one-to-one calls, feel free to book your call today, and let's see how we can kind of help you and get you to the next level.